Cramer. Welcome to Mad Money. Welcome to Cramer. If you make friends, I'm just trying to make you a little money. My job is not just to entertain, but to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Earnings matter again. Okay, that's what happened last night when the United States and China reached an agreement, however temporary, to hold off trade Armageddon. The rollback of the exorbitant tariffs to much more reasonable levels caused the stock market to explode. Dow jumping 1.161 points to 1,161. The S&P surging 3.26%, and the NASDAQ pole vaulting 4.35%. The reaction? Instantaneous. Stocks erupted. Everything had anything to do with the world economy, not just stocks directly related to Chinese trade, took off with huge gobs of gains made today. It was a spectacular day for the bulls. One of the smartest I can recall. Very rarely have I seen the stock market actually get surprised by something from the White House in a positive way. We've now seen it 3 times in barely over a month. 1 bad, 2 good. First, April 2nd, Liberation Day, the day that will live in trade infamy, when President Trump declared a trade war against the entire world, which caused a 2-day decline of over 10%. Then he surprised us again by pausing those tariffs by 90 days for most countries, triggering in more than 9% gain on April 9th. It happened again today with the news that the embargo-like tariffs on China will come down to more reasonable levels, albeit still higher than before Liberation Day. The market rebounded hard, but what was most interesting? I don't know, to me, it wasn't only a bounce in tech stocks tied with China. You'd expect that, right? We got to jump in all tech and in many other stocks with any economic sensitivity. It was a day when earnings estimates took on new meaning, and it could bring about higher prices for some time. Let's parse how this all came to pass and why it was such a surprise to the market. First, there were always 2 camps close to the president. One wanted China back to where it was before it was admitted to the World Trade Organization in 2001. Now, it was a very big deal because China fully opened its economy to exports, but also wiped out a ton of our industries. A rollback of that proportion could have done real damage to China, but it would also bring down big chunks of our economy. The second camp, the one that seems spearheaded by Treasury Secretary Bessent. Let's call this one the cooler heads prevailed contingent. They negotiated the pause in the big tariffs and a reduction for now to levels that are still significant, but they are not punitive. That's important because many investors believe that punitive tariffs there mean catastrophe here. Now, I don't want to make any judgment about whether all of this trade brouhaha was a part of the art of the deal. Yeah, one big negotiation, or the president simply changed his mind after seeing how much carnage the original plan unleashed on the stock market and on consumers and retailers who feared hoarding and empty shelves. What really matters, at least to the stock market, is that many hedge funds didn't believe Trump would change his mind. Stocks have become heavily shorted, betting that Trump would never give in, even if it wrecked our economy. Now, we don't know if Trump allowed for a temporary compromise because the economy did seem to be troubled and Fed Chief Jay Powell wasn't going to respond with rate cuts. That's the, cognoscenti say stuff like that. Or because the weakness was starting to turn into fear, raw, naked worry about what would happen.
The House of Pain.
Think about it. How many times have you heard that we were on the road to an unavoidable recession because of the China tariffs? That became the cause celeb that the Bears wouldn't let go of, a pot of honey for the Grizzlies that was oh so close, as the talks already thought to fail produced nothing all weekend. But the early morning announcement gaffed these Bears as surely as an Earth sign character walking around in a New Jersey backyard. Boom. Now, let's talk about the beneficiaries. The first, the companies directly affected. Here, let's talk about Apple, Broadcom, and NVIDIA, all of which we're about to see a chunk of earnings disappear or become jeopardized by an ever-harsh relationship with China. Same with the semiconductor capital equipment, thinking about the Lambs and the KLAs that have already seen their earnings cut back by a decline in trade. Apple's been treated like a piñata ever since it reported because of a belief that it would be unable to shift enough of its Chinese manufacturing to new countries like India, and then its service revenue skipped a beat on that last quarter. NVIDIA has been perceived as a hot potato where you never knew where the White House might stand. Broadcom has a ton of business that could be impacted by China. And by the way, its stock has been smashed beyond all recognition. That's been a real winner. These 3 stocks were easy prey for the bears who captured the mic, including both strategists and hedge fund managers. Now, you might want to include Amazon in that group because it did a ton of business with Temu and Shein. Those are the Chinese companies that thrived on a tariff loophole that allowed their goods to flood our markets. Now, we don't know if they're going to get that break back. It wasn't announced last night, but Amazon stocks sure act like it would. Then there are the techs that benefit from a possible avoidance of recession. Take Meta, which rallied nearly 8%, Alphabet up 3.7%. Neither has much direct exposure to China, but they would still be it would be collateral damage from a slower economy. But the most quizzical were all these other groups: financials, industrials, transports, consumer discretionary stocks that might have been crushed by a recession. Classic case, the banks. Now, they're always the first to be annihilated by any decline in economic activity. The three I key on are Goldman Sachs, Wells Fargo, and Capital One. Why? Because my Travel Trust owns all three. Join the club, find out about them. All three of these soared, with the latter, Capital One, most sensitive to potential defaults because of its poor credit card clientele. That skyrocketed more than 6%. It has been my favorite in the club, so I'm kind of proud of it. That the latter cohort could rally even as the group that had nothing really to do with China directly, well, that just shocked a whole lot of investors. Could there really be such a reaction of reverberation from this China stay of execution? Yes, absolutely. Why? Because we'd all become used to the idea that it didn't matter how good their previous numbers were, the ones they just reported. What mattered were the future numbers, the estimates, and they were coming down hard because analysts believed that the president's trade policy would most likely cause a recession. So the estimates, they were going to go lower even year over year. That fear made their most recent quarters completely irrelevant. You could own virtually nothing except the most defensive stocks, utilities, some of the safer food stocks, better drug stocks. How about this for irony? The president announced this very morning some unilateral drug price cuts, ones that can't really push through, he can't really do on his own, even though initially people thought they could, and the stocks just cratered. Later on, we realized that perhaps they would just be a negotiation. They still got hurt, but then they came back when people realized that Big Pharma doesn't know how to roll over, and it's going to fight tooth and nail. Most safety stocks failed spectacularly, though. Their declines were stark recognition that while the president may not be fixated on stocks, they're always a focus, and he doesn't want to annihilate the stock market. Too many people own stocks in this country. Now, we know that we won't be free of the bears here. There's too much at stake. They don't want to seed the rap that Trump could still cause world trade crash. And you better be short it, that's what they say, and take the advantage of this rally to short. But I come back and say that we see how easily stocks can rally. Isn't it a little dangerous to be that short? Bottom line, it's better to stay in, stay on, and let it ride than to try to pick the perfect moment to trade in and out of the stock market. By the way, that's not much of a strategy. It's more of a game of chicken, where there are no winners, just losers who think they are smarter than the average bear. I'm going to Jeff in Texas. Jeff.
Speaking.
Jeff, what's up, buddy? It's Jim.
Hey, how are you, Mr. Cramer? I was just wondering what your views were about Mondelez.
All right, it's a really interesting question because this has been this has been the food stock that's been the best. Okay, the best, even though it's got a lot of chocolate in it, which doesn't make much sense to me because chocolate's supposed to be something that's really been attacked by the GOP-1s. That said, I think that it's done well, and it's got a 3% yield. I'm not against it, and Dirk Vanderput has done a pretty good job there. How about Mike in Illinois? Mike.
Hi, Jim. Welcome back.
Thank you, Mike.
I have a nice position in Lilly, which I've accumulated over the last 2 or 3 years. I'm wondering if you think I should buy, sell, or hold.
I want you to buy more. I'm glad you mentioned this because at one point today it was at $6.99. I wanted so much to tell people to buy it, but that was around 6 a.m. The reason why you want to buy it is because there was definitive data that came out last night about Novo Nordisk not being anywhere near as good as Eli Lilly when it comes to waist loss, which is what a lot of people are in the GLPs for. And it was not reflected because the things were so crazed because of what the president announced. I think the stock could be up 100 points when people realize, wait a second, it is definitively better than Novo. I would buy Eli Lilly hand over fist. Let's go to Simon in Delaware. Simon.
Hey, Jim. Booyah. And thanks for taking
Simon.
my call.
Of course. What's going on?
The stock I want to ask about is HPE. I have been holding this stock a long time. I'm kind of embarrassed to tell you how long I've been holding it. You know, back to its pre-split days with HPQ, who has enjoyed some success.
Right.
But HPE has apparently just been stuck. It goes up a little, down a little. It's traded inside a very small band for like 10 years.
Well,
So
you
my
know, it's a
question
very
to you-
competitive spot, Simon. It's a very competitive area. You're up against Dell, a bunch of other companies. And so, therefore, I think that even though it sells at 10 times earnings, it is still a very difficult stock to own. So I'm not going to recommend the stock to you. Don't buy. Today's action shows you how easily stocks can rally. So I say it's better to stay invested. Remember, I say stay in rather than try to trade in and out and in and out, as so many people advise. On Mad Money tonight, I'm examining the state of the consumer with shopping center REIT Kimco. Don't miss my exclusive with Top Brass. Then, should you be shifting your sights to the global markets as tariffs continue to affect the domestic tape? I'm telling you where I stand, fresh off today's rally and my trip to Europe. And Cramer asked me a question on AI player EXL, and I'm doing my homework and giving it right to you by talking with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.